There we go. A little bit about us. You know, our whole team came from MF Global about a year and a half ago. We're 60 of us. We do only metals. We deal with people like yourselves in the commercial metals business. We deal with some funds, but really our background is metals. Many of us have been working at manufacturing companies, so we know many of the issues that face people like yourselves. This is just some rankings. You know, we've always been rated, fortunately, #1 in execution, clearing. We won a bunch of awards. This is all our team. So I'm very pleased to be working with such good professionals. And I know Paolo has been with us for many years. Paolo, I looked at my slides from last year. This was one slide I had last year as to what we're going to have in 2012. So I said we're going to be range-bound, not very bullish, not very bearish. We said that China will be the big question. Iran, at the time, there was all talk about war and stuff like that. The euro was a big question. And in the United States, housing, you know, that was very important. It was just starting to get stronger. And we recommended at the time, you know, everybody should be flexible on hedging, not go too far out, and stay somewhat flexible. Our price forecasts were a little high, not too high, but not bad. You know, we were certainly better than many of the banks. Housing, let me talk about the US a little bit. Housing, I think this is the big positive in 2013. For the US housing market is starting finally to pick up. There's never been a recovery in the United States where housing has not come back. This is the first time where we're finally seeing, after 5 years, housing is starting to come back. Sales of new homes are going up 30% year on year. That's not a very important indicator because it's a small number, but it's still very good. Existing homes, which is the middle chart, that's up about 10%. That's very important. And most importantly for people who own homes, their prices, they want to see the prices of the home go up, and that's up about 7%. So, you know, when people feel good about their homes, or home prices, and their jobs, they're confident to go and buy homes. You know, so that's the main sector. Another thing that's improving is the labor markets. As Dr. Saddam was saying yesterday, unemployment is coming down. Initial claims, which is, you know, the unemployment claims, that's coming down. It's the lowest in 5 years in the United States. And the number of jobs is finally going up. But employment is really a bit of a tricky indicator. You know, the number of people, we still need many, many millions of more jobs in the United States. And we, in fact, need jobs all over the world. It's not just the United States. Jobs is the key negative, I think, right now. We really need many more jobs for all these graduates coming into the labor force over the years. We're getting there in the United States, but we still have a lot more ground to cover. What are some of the problems we see in the US? Well, the political situation is a big mess. We had this drama at the end of last year with this fiscal cliff. They agreed at New Year's Day. They had 9 months to make an agreement. Finally, on New Year's Day, they agreed to raise taxes for 600 billion over 10 years. They have to find another 4 trillion. And they're still fighting over it. Now they're negotiating a budget. So on the fiscal side, it's still a work in progress, but the markets seem to be allowing the politicians to get their negotiations together. What's more worrying is the Fed. Look at some of these numbers I put together. The balance sheet of the Fed was $30 billion in 1960, okay, 30 billion. If you see GDP growing, the Fed budget should kind of grow, the Fed balance sheet should go up with GDP, which is about 3%. Over the next 50 years, it should be around 300 billion. By the time before Lehman, the federal balance sheet stood at 900 billion. So it was higher than the norm by about 600 billion. 7 weeks after Lehman, it doubled, just in 7 weeks, to 1.8 trillion. 2 months after that, they raised it again. 900 billion, it's 2.7 trillion. So if you look at the chart, it's like this, and it goes straight up. And the question is, what happens when they start pulling this back? And I think that's the unknown. Nobody knows what's going to happen. But this gives you a good historical perspective. When you hear these numbers, they don't mean anything. But when you see it go up like that, you have an idea how out on the limb they are. China, well, we've talked about China. Everyone has the same story. What is the real growth there? The numbers we're seeing is 7.5% to 8.5%. A lot of this is government spending. The export sector, it's picking up, but even those numbers are a little bit dodgy, not exactly true, because the Chinese say we've exported 10% more of widgets or whatever to Japan, and then the Japanese say, well, we didn't get that much. We have less than that. So we don't really know what some of these numbers are like. So the export market for the Chinese is still soft. The consumer market for the Chinese, interesting, everyone talks about the consumer spending in China, but actually the consumers are, as a percentage of the economy, consumption as a percentage of the economy is actually less than it was 15 years ago, not more. It's not like the US where they buy everything. The Chinese buy much less and they save much more. And they actually are spending less than they were 15 years ago, mainly because the government is spending so much more. Now, if you look what you think about China for the year, housing is a big problem, I think. I think in some parts of the country, it's really a bubble. I saw a video last week on a television documentary, rows and rows of empty houses, people just buying and selling them. Nobody lives there. There's no people there. And I couldn't believe what I was seeing. It was really remarkable. So the government is starting to try to control these increases by putting taxes on, making down payments more difficult, restricting buying. So this is going to be very important for our markets because construction is going to impact metals like zinc, nickel, steel, of course. So we really don't know what's going to happen in housing, but the signs don't look too good to me. Of course, there's a new leadership team in China now, and if you listen to what they say we want to have freer markets, less corruption, less pollution, more flexible exchange rates. Well, if they put their program into place, that means they have to have more competition, they have to reduce excess capacity in some of their factories, they have to sell or downsize their state-owned enterprises. They have to let the yuan appreciate. They have to open up their markets. So if they do all this, you're going to get a rise in unemployment. You're going to get a rise in political tensions. So, the question is the government going to follow through with all these measures, or is it just talk? To me, I think it's going to be very difficult for them to do it. Because like I was saying yesterday, they would rather keep the social peace in place. Europe, we've talked about quite a bit yesterday. From last year to this year, the debt markets have been really much more calm. The yields have come down because of the ECB, Mario Draghi coming out, as Stephen was telling me over lunch, saying, reminding me that he said, we will do whatever it takes. he's almost like Ben Bernanke. Same thing. We will do whatever it takes. But, you know, to make the credit markets calm and flexible is not the same thing as providing growth. So they have a problem. They have stabilized the credit markets, but they haven't figured out how to get the growth back into the economy so people can start working again. And there's reasons for this. I won't go over all the technicalities, but you're familiar with them as much as I am. You know, the tax problems, the labor problems, the banking issues, all of these things. And of course, the main thing is the euro. The euro is still too strong at $1.30. It's still too strong to get the exports going again. I think you need a much lower euro for some of these countries to start growing. This year's Eurozone GDP is expected to be down 0.5%. I think, you know, I think it will have more of the same this year. The debt markets will be, you know, I think pretty calm because the markets will not allow the extremists to come into power. So if you saw the elections in Greece, the opposition came in, but they couldn't really control policy. Same thing in France with Hollande. He came in saying he wasn't going to accept things, but at the end, he didn't have much sway. Cyprus is a bit of a different case. I think it was terribly handled, what they did in Cyprus, just awful, because the numbers are very small. It's only a $20 billion, only a $20 billion problem for Cyprus. And it could have been solved, but the problem was, as you know, they have a lot of Russian deposits. So the Germans were saying, we don't want to give more money to bail out Russian oligarchs. So they said, we're going to take some money from the accounts, and they didn't get it done. So now they have scared everybody. Once the banks open, all the money is going to go. It was really terribly handled, terribly handled. So this is kind of our trajectory. You know, US will be up in terms of influencing commodity demand. China up still, or maybe kind of sideways if the housing is a problem. Japan and EU, unfortunately, down. They're still going to be struggling. I'll just move on to the individual commodities now, starting with copper. You know the list by now. You know the fundamentals still look bearish. Inventories are high. In LME, 540,000 tons, 2-year high. In Shanghai, it's a 1-year high, 225,000. There's about 1 million tons stored in China off exchange. We know copper is free, quite available because treatment charges are high. That means there's a lot of concentrates. The Chileans are doing very well. If you remember, a few years ago, there was always problems with Chile. They couldn't get enough copper. They had problems with the mines. They had labor issues. This year and last year, they're expecting large increases out of Chile. And of course, you have other sources of supply, such as in Mongolia. That will be coming online in June. So the supply picture is very comfortable. On the demand side, China is the main one. Their demand is going down a little bit for copper imports, as you can see. Scrap is holding up a bit better, but also coming down. The yellow is for January, so that's also continuing a lower figure. Of course, is all of this being used in consumption? There is an issue about that, as Stephen and I were talking about yesterday. A lot of this copper is being used as collateral to get money from the banks. It's not really being used to make air conditioning and things like that. So even those numbers could be a bit high. Aluminum. Well, we all know the story on aluminum. It's 5 million tons on the LME, another 3 or 4 million off exchange. So 20% of the world's supply is sitting in warehouses. All of this stock, as you know, is tied up in these financing deals. But, you know, there could be some pressure on these deals over the next year or so. I was saying yesterday the banks might start to get out of this warehousing business because the regulators don't want them to be in non-core activities. Interest rates could start going up. It makes some of these deals less attractive. So it's going to be a source of pressure on aluminum going forward. Plus, output continues to rise. You know, we are now at 45.5 million tons. We're expected to produce this year. It's going to be another surplus. What's helping the producers is the premiums. The premiums are remaining high because there is, you know, the aluminum is not coming out as quickly, and it's going into these deals. This is a picture that shows you. I don't think it's a Pecorini warehouse or a Steinweg warehouse, but it could be. So when you want to go in, you have a big garage. When you want to come out, a small door. Again, China, a lot of production this year coming out of China, up 11% from last year. Demand is only up 8%, so you're going to have a local surplus again in China. What's going to happen with this metal? They'll either stockpile it, or the government will give the producers extra money to keep producing it, subsidies, or they will make a product and export it duty-free. But the Chinese supply-demand picture is surplus, definitely. The Western producers will probably cut back, but they're not. It's not going to be enough. So Reuters, the poll of analysts, they're looking for about a 700,000 ton surplus in aluminum this year, 800,000 next year. Of course, if prices fall a lot, the cutbacks become more, especially out of China. So we'll see. I think below 1900, you'll really start getting some pressure to have cutbacks. Zinc. By the way, these charts are about a week old, so prices are a little bit lower from here. Again, high inventories. Surplus this year, 265,000 we had last year. Another surplus this year of about 114,000. This is the Reuters poll. A lot more zinc coming into the system because there was some concentrates that was not getting treated. Now that the treatment charges are going up, especially in China, there's going to start treating this metal, and it's going, you know, I think the LME stocks will continue to increase. Longer term, zinc could be interesting because a lot of the producers are closing extra capacity. Xstrata, some others, they're going to be shutting down about 2 million tons of mine capacity over the next several years, and only about 800,000 of new capacity will come on. Lead looks really good. I think lead is one of our favorite metals if you had to choose one, mainly because, you know, the surplus is very low, 64,000 tons. Just so you'll know, consumption is 10 million tons, so it's not a lot in terms of a surplus. And next year, we really don't, I mean, this year, we don't really know what the market will do. The Reuters forecast is calling for a deficit of 100,000 or a surplus, but whatever the number, it's still very low. We think it'll be about a 30,000 ton surplus this year. Stock ratio of 3 weeks, which is quite low. And LME stocks have been falling in the last few months. Lead is the only metal where the stocks are falling. And of course, Chinese demand is very strong, especially on the concentrates. And I think the main thing about lead is the environmental issues. Nobody wants to have a lead activity anywhere close to their village or town or whatever. So the environmental factor, I think, is very important in lead. Nickel. Nickel had, as Paolo was saying yesterday, had a big run the last few months, and I was very puzzled. I said, you know, nickel doesn't look so good, and it's gone up like almost $2,500 in 2 months. I couldn't understand what was behind it. And sure enough, when a market moves on no fundamentals, it's very vulnerable to a decline, a sharp decline, not just a minor decline. And you can see what happened just in the last 2 weeks. I think we were down almost the same amount. We lost $2,000 in 10 days. It took us about 2 months to get up there, and we lost it all in 10 days, which shows you, you know, if you have a weak fundamental profile, you're on shaky ground. This is just some of the statistics behind it. I will make my presentation available to Paolo later, but basically we see another surplus for this year as well as last year. LME stocks are going up. The other problem nickel has is nickel pig iron, especially from the Chinese. This is almost like an alternative supply source. The more nickel goes up, the more pig iron is being produced. So in a way, nickel is capped, because if it runs up too much, they'll just make more of the cheaper nickel-contained pig iron. And pig iron costs are very low, $12,000 to $16,000, and their applications are broadening. More and more people are using pig iron nickel for a variety of stainless applications. With McKinsey, a consulting group, they're saying that 25% of the nickel industry is now operating at a loss. It's probably a bit higher than that. And producers are starting finally to cut back. Vale, Xstrata, they're trying to cut back to bring the market into balance. But it looks like we'll still get a surplus this year. Tin and lead, again, like last year, were our two favorites. Tin, I think, is a very good metal to trade. I think it's not in any of the indexes, so it's not going to be bounced around as much. But it's going to be in a deficit this year, the only metal that will be in the deficit. Its stocks are very low, about 50% less than last year. Consumption is across a number of industries, so it's not only in construction or like zinc is, or it's spread out among a different base, electronics, tin plate, manufacturing. So you have a bit more diversification. And most importantly, tin is produced mainly by Indonesia. And you have, you know, it's the Saudi Arabia of tin. You have a problem in Indonesia, tin can move. Eataly is the International Tin Research Institute. They see prices at $25,000 a ton next year, and then possibly to 35 to 40,000 by 2015. So these aren't banks. It's more of an impartial research firm. Steel. Paolo asked me to say a few words on steel. This is the NYMEX hot roll coil price. You know, kind of stabilizing a bit. But again, here the profile looks pretty bearish. You know, we have a lot of steel being produced, up 1% from last year. The Chinese producers, they're not cutting back. They're seeing government spending, government infrastructure projects. They're seeing an improving car market. So they keep producing more steel, despite most of them losing money. The government is trying to consolidate the industry. They want to get the more money-losing operations, get them out, merge them. Again, this will mean more unemployment, more closures. So it's a delicate process. And we have, in the meantime, more and more steel coming out. Prices are finally responding. Shanghai prices are down now at 3-month lows. Russian, Ukrainian hot roll coil prices are down in April. Quotes are lower in April than for March. There was a series of price hikes in the States, but I think many of those are not sticking. The Chinese, again, the property market is a big question. 30% of the steel goes into residential, commercial building. 20% is going into the government infrastructure projects, and 50% is a variety of manufacturing. So All of these are vulnerable except for the government spending side. And look at these numbers on the Chinese output. In 2012, they produced 716 million tons. Consumption was 685, so a big surplus there. They have a capacity of 900 million. And in 1976, they were only making 30 million. So 30-fold increase in capacity. All right, well, I'll just say a few words on the funds and then wrap it up because that's very much of interest. You know, there's several kinds of fund classes, macro funds. People like George Soros, they can buy and sell whatever strikes them. Commodity trading advisors, or CTAs, that's in blue. These are people who follow technicals, moving averages. They don't care anything about supply demand. They just look at quantitative models. Index funds are the pension managers. They just buy a basket of commodities just to have some diversification. And then the recent phenomenon is this ETFs, which are these derivative products being offered by banks. You can buy copper, you can buy gold, and you can buy any of these things as an individual stock, and it follows the price of the underlying commodity. This is just the money that's going into various of these funds. The main takeaway, the main point of all this is that the money going into commodities, especially the last year, is starting to come down to sideways. So whereas we had this big move, we were talking about this big price move in copper in 2004, 5, 6, it was all this fund money going into the commodity markets, as well as a bullish profile. But that money is now sort of leaving a little bit. But if you look at the copper price in blue, and you look at fund money, you'll see the correlation is striking. It almost moves almost one-to-one. This is about up to a year ago. So since then, copper prices have come down, fund money has come down. This is one of our more popular graphs. It just shows you how important it is to follow the money flows. Why are they getting out? Well, the bull market is finished, so you know people like to buy commodities when it's going up. They don't like to buy when it's going down. About 30 billion has left in the past month, most of it going into the stock market. Gold has really gotten very badly hit, as most of these fund managers have gotten out of gold. And it's a rotation, as I was saying yesterday. You know, it goes from the commodity markets to the bond market to the gold market. Now it's equities, and who knows what will be next. We talked about this yesterday, this divergence between the equities and stocks. You see the Dow Jones on the bottom, the CRB on the top. Again, for many of the reasons I was saying earlier, fund money is moving from the cold market to the hot market. This is a good chart. If you're doing modeling, you want to find, you know, you don't trust any analyst. You just want to put in a number from the consensus. This is the Reuters poll that's come out about 6 weeks ago, where people are seeing prices mean, high, low. This is about 20 analysts polled. Copper, there people are thinking 81.35 is the average. Interestingly, for next year, they're seeing 7,800, so lower on copper, but higher on everything else. So this would be a good table to have, just to have the sense of where the crowd is. Usually more bullish than I am, but, and this is our numbers. We're looking for an average of copper of 7,800, the high 8,450. Goldman Sachs is looking for 9,000 in 6 months, 9,000. Morgan Stanley is looking for 8,600 average for the year. That means we have to be at 9,000 for the second half and hold. I mean, I don't know what these people are smoking. But you know, our numbers are kind of a repeat of last year. Trading range markets, nothing very exciting. Gold, I think, is vulnerable. Gold could go down to maybe 1490 before it's all over. Oil, 127 to 98. I think with Iran, there's going to be a $20 swing either way. If they hit Iran, $20 higher you can see on oil. If they don't hit it, if there's an agreement, you could see $15 sell-off in oil. So I think the oil, you really have to, it all depends on what's going to happen with Iran. That'll be interesting. And I think the stock market will do better this year. 15,000 on the Dow, another 600 points from here. Euro, maybe we'll get down to 125, but more of the same. 130 is the average. Thank you very much.